Hey guys, Akil here. Welcome back to another video. Before we get started, I want to give you a quick reminder. Next week, so starting Tuesday, we kick off our free 3-day trading workshop. Make sure you sign up. This is going to be your last warning. There is a link in the description box below. Register, that way you can catch it live and secure your seat, or you can watch the recording, and of course you can do both. The main theme of the workshop really stemmed off of the fact that there's been a massive decline in retail trading in the first quarter. And we kind of put our brains together and listed off a few reasons for why that is. And one of the main reasons that is because, well, traders are getting a reality check of what trading actually is. It's very easy to be successful in an easy trading environment, but the true test of a consistently profitable trader is, can you be consistently profitable over different market environments? And as the markets return to kind of normal, traders are starting to see how hard or difficult it actually is. After all, 90% of traders fail, or 90% of traders lose 90% of their funds in their first 90 days. So it's no surprise that many traders are getting to that 90-day mark and they're starting to kind of get a reality check. And one of the reasons, there are many reasons that traders struggle, and we'll go over a lot of them in the event, and of course give you solutions on how not to fall into those pitfalls. But one of the reasons is that a lot of traders have false expectations, and one of those false expectations is trade frequency. They think of trading kind of like the wild, wild west or the casino, where they're coming in and there's this many trades every single day. And the reality is, I guess it could be like that. You can certainly have a high frequency kind of day trading strategy, but the reality is good trades, and those are the trades that we're after, right? High quality trades, A+ trades, are going to be far and few between. And I was having a conversation this morning with one of the traders I work with, who, you know, I get a bunch of us have been joking on the platform. There was a setup that we all missed by 1 pip, 1 tick. So it was very, very close to giving us all the requirements for what we need to take the setup, but very close isn't the same as everything has been hit. So we're forced to sit on our hands, meaning do nothing. So we're kind of shooting the you know what, try to keep it clean for YouTube, and just joking back and forth about, I missed it by 1, I should have done this, should have done that, you know, making light of a painful situation, just joking around. But the honest truth is, right, in the real world of trading, meaning outside of kind of the group we have here at Tier 1, where we have a professional mindset and we can joke and stuff like that and not worry about traders kind of messing up, because we know that, you know, our main goal is follow our rules, and it would have been a bad trade if we'd taken it. The reality is that many traders would have broken their rules during that trade. Another thing that this trader said is that, man, Akil, it's been about 2 weeks since I've gotten a trade, so I really, really, really wanted this one to complete. I've been waiting for it for a while, so it sucks even more that I missed it. And as I mentioned before, we don't get a lot of opportunities. For you guys that have been tracking this entire year, I've only taken about 53 trades. And if you kind of average that out, it's about 2.7 per week. I'm on pace for about 130 for the year. And I would actually expect that to slow down some as the summer comes. So you can see 50 or 49 for me weeks of trading, only producing about maybe a little bit over 100 trades. It's not too much. So trades, the good trades, are very, very important, and we don't want to miss them. But on the flip side, when we do get opportunities that are close but not good trading opportunities, if you are a trader that still hasn't mastered their emotions, you're still struggling with the trading psychology part, that can cause a lot of damage, because you feel this need, this desire to be in the market, right? You're doing all this analysis, you're watching everyone on YouTube, you're listening to everyone on Twitter, and everyone's taking trades left and right. FOMC is coming out and this is happening. CPI came out and this is happening. Everyone's making millions of dollars but you. And you're sitting here following your rules and skipping trades because it missed by 1 pip. Well, sooner or later, you give into those emotions and you start doing things you're not supposed to do. You start either taking trades that are bad trades. 1 pip was close enough, I'll take it. Or you start finding other trades, maybe that, you know, someone on TV said it, or one of your friends said it, or maybe I mentioned it in a weekend video and you decided to blindly follow me. Either way, you start doing stuff you're not supposed to do. And whenever you deviate from the plan, you go broke. We'll just put it nice and simple. You will go broke. Some people go broke quicker than others, but eventually it all ends in the same place. You will go broke. So you can't give in to those emotions. You have to have the mindset that I'm only here to take my trades, my grade A trades. Those are the trades that meet my rules, not 99%, but 100%. They fully meet the rules. And we have to be disciplined enough to, only take those types consistently. And again, this is kind of a sneak peek of what you're going to get in the workshop next week. Imagine that, but for 3 hours a day, 3 days straight, with a lot more examples and a broader range of the struggles that traders go through. So enough of the rambling. Let's hop into the charts. Let me show you some of the greatest ideas. Let me show you the greatest ideas that are on our radar for the week ahead. So believe it or not, but the euro dollar is going to be the only Forex pair that we look at this week, I believe. We may go pound dollar, but it's in a very similar situation, so I don't think we need to look at both. But euro dollar is a pair that we've been debating in the live room this whole week. And by debating, I don't mean like we're trying to say one side is right, the other is wrong. But we have different type of traders in the room with different mindsets. My mindset is more counter trend based than trend continuation based. So I tend to believe that structure is powerful. It's the almighty. I believe it will hold until it has proven not to hold. On the other hand, you have trend following traders, right? Trend traders who are the exact opposite, right? Their whole kind of bias is that, hey, the trend is your friend, it will extend, and structure is just a weak little fence in its way that's waiting to be smashed down. So we've been kind of going back and forth. As you can see, euro dollar trading at a previous level of structure of a group of traders thinking that this structure level is going to be broken, and we're going to extend to 123 or 124s, and another group saying, hey, we're at previous structure highs, we've yet to violate it, let's kind of pump the brakes a little bit. And we can still break through. Nothing has shown us that we can't yet, right? We've double topped here. Our last move or our last two moves are right back down into a previous level of inside structure. So far, price has held there as well. So it looks like we may consolidate. We're going to kind of go up and down, and we're going to have that battle between buyers and sellers, which is 100% normal. This is a perfect example of we want to be predictive in our analysis, reactive in our execution. At this point in time, at least for me, I can make a prediction, right? I think we are going to go lower, but I don't want to react, meaning actually put any trades on the table until price has given me a clue. And I can do the same thing for the upside. And essentially, I'm looking at it like this. I'm looking at the two extremes of this channel, our high level of resistance here, our low level of support here, and I'm just waiting for a break. Right? If we can violate and break the highs, and this level will be a little bit higher, kind of at the extremes of our previous highs over here, but you guys get the point. If we can violate this level, right? If then thought process, if we can break and close above that level, sorry, I'm looking for my nifty arrow tool, then I would expect a move higher to, again, 123s, 124s, vice versa. If we can violate these lows down here, I would expect a retest of really the 121 level, right? So going into the weekend and going into next week, I'm just kind of in a wait and see mode. Whatever hand the market wants to show, it's going to tell me exactly what side of the market I should be involved in. Now, there are many ways to get involved in this, many other ways to get involved in this, I should say as well. One of them is just being a channel trader, right? We held that structure here. You can play this bad boy back and forth across the channel all day until the channel's done. So that's another method as well that you can take here on the euro dollar. I was going to mention 26.18 is a little bit early for that, and that'll come later in the week if we indeed get that break and close to the downside. All right, so next we're going to look at the S&P, and for you guys that are pattern traders, it's a little gappy, a little choppy as you'll notice, but you should be noticing a potential Gartley pattern, right? We have an initial impulse leg, our X to A, our swing high to swing low, our first retracement. This is going to be our A to B. We then have another retracement giving us our B to C leg, not violating the A leg down here. And if we extend up, I'm going to go ahead and bring my 127 Fibonacci extension on from swing low to swing high. If we extend up, we're going to have a potential bearish Gartley right at our 127 extension there for a potential short setup. That was a short analysis, but with pattern trading, it's pretty simple. It's pretty black or white. we know the formation, we know the completion point, we know the completion zone, I should say, if you want to measure this out from the 127 all the way to the X. For me personally, I'm aggressive with patterns, so I just put a limit order on and a stop loss on, and boom, it's good to go. Obviously, if you're looking for other reasons to get involved, once or if price action reaches your completion zone, then you're looking for those reasons for entry. Now, before we get into the next pair, I want to give you guys a quick reminder. I did put out a midweek video sharing with you a trader assessment and trade review that we did in the live room. Super powerful stuff, especially if you're a struggling trader or you're new to the whole concept of rules-based trading. Make sure you check that out. I'll put a link in the YouTube description box below. Also, this Thursday, Jason Greystone and myself launched our pilot episode of the Trader Coffee Break. This is going to be a weekly show. The first two are pre-recorded, but we're going to be live every Thursday discussing really everything you need to know to take you from beginner trader to consistently profitable trader. So it was great. Thank you guys that joined. The chat was amazing. We want it to be a conversation with you guys and not just me and Jason talking. So hopefully we can grow that even more next week and continue to grow the show. But check out that first episode. Make sure you subscribe and make sure you check out this Thursday's episode as well. It's going to be powerful. Now, to follow that up, we're going to go to the Dow. You can see similar type of setup, not going to be as deep as the S&P, I believe, but same type of setup here on the Dow Jones. X to A is going to be our initial impulse leg that starts our pattern. Our A to B is going to be our highest retracement right here, the second top of this beautiful symmetrical double top. Oh, you're so sexy. B to C is going to be our first retracement there, and then our CD completion once again is going to be at this 127, giving us a potential advanced pattern, or a Gartley pattern, bearish Gartley pattern with a zone like this. Now, here's an interesting thing for another take, right? If we draw a horizontal line on our B leg, because this was our most recent level of previous structure resistance, this is going to offer two opportunities as well. One, for a counter trend trader, so for someone with a bearish bias, someone that's looking to get short. If this level of structure holds, this is going to offer a short opportunity. If we break higher, if we break and close above this level, you can look for longs in advance of the advanced pattern completion point or towards the previous structure highs up here. Going hand in hand with that is going to be the NAS, right? You can see same thing. It's repetitive, right? Potential advanced pattern formation. This one's going to be a little bit different. This is going to be a bat pattern, but an X to A to B, B to C. Because it's a bat pattern, our D completion is a little bit higher, which I personally prefer. This is why bats are my favorite advanced pattern formation to trade. I don't know how many have I taken this year. I was about to say I've taken more bats than any other type of trade this year. It's actually tied with Gartley's. I've taken 16 bats, 16 Gartley's, only 10 ciphers. Ciphers is the lower, 11 price action trades. Usually ciphers are the most frequent, but this year's been a little bit different, I suppose. Anyway, bats are my favorite because they offer a really, really good risk reward with the D completion being so high to the X leg. Now, same situation as the Dow. If you go down to the 4 hour, this will give a great example of that, right? You can see that if we erase the junk here, if we draw out a previous level of structure at our B leg right here, you can see that we violated. And this is exactly what we're looking for. We had a violation, a break and close above. We had a loss of momentum pattern right here. We're getting a retracement, and we can look for an extension higher, either to the level of that potential bearish bat pattern or to previous structure highs. It's going to be in a very similar zone again, since that 886 is so high. Real quick, I just want to bring up my indicators real quick and see what we're doing here. I may talk to myself and get a little bit nerdy. If I do, pardon me. This is what you get with Akil's random videos. I don't pre-rehearse these. I kind of just go after it. I'm just going to draw on my RSI zones. This is something that we've been looking at in the live room for the better part of the last 6 months. If you've been following the video each and every week, this is something that we've been looking at and I've been explaining in the video as well. So make sure you're going back to past episodes and looking at it. But yeah, we're still in that bullish zone right here. Help if I made this green. The things I do for you guys, the editing I do for you guys. We're still in that bullish rotation zone when it comes to our RSI. So that's a positive sign as well for a continuation in that direction. So yeah, this is looking to set up a pretty decent pullback trade. So certainly something we want to watch as we open up in the markets next week. One last thing while I'm here, because I'm interested in this now. Again, if we're looking for that 886 as a potential target area, let's just see where a 127 extension would draw or come in from this leg. 886 is right up here. Let's take our Fibonacci extension tool and let's drag it from our swing low to our swing high, this last swing here, and back down. And yeah, look at that 127 extension. Right over that 886, right in the same area. So it looks like the bat pattern completion point, or the start of the completion zone, looks to be a decent level for a take profit as well. If not there, then slightly lower at our psychological level. Either way, especially with the pullback happening, should offer a decent amount of profitability.